Okay. Oh, so it's important to look at this to differentiate between an acquisition of an asset, an acquisition, a divestiture of an asset, an acquisition of an entity, a divestiture of an entity, which is what we will go through. Very generally speaking, an acquisition of an asset is used when purchasing a tangible or intangible asset. And just to formalize this, in order to do that, all you would do is increase the PP&E, the fair market value of the asset, and adjust the debt and equity accordingly. And I want to mention fair market value of the asset because we are assuming that the price paid for the asset will be its newest value, no matter what the value was, right? If you paid $25 million for the asset, it could have been worth 15 million, 20 million. You're recording the PP&E at the price paid. You are stepping the asset up to the price paid, which you often do for fixed tangible assets. In entities that are more complex, when you're paying more for the entity than what it's worth, that difference goes into goodwill, and we'll go into all this purchase price allocation. We will get into that difference, but it's important to acknowledge that difference. But quite simply, these are the movements, right? Where we talked about you first raise the equity, and you first raise the debt, and all the kind of side adjustments that go with that. When raising equity, there's an impact to shares. When raising debt, there's an impact to interest and taxes. This does not show, if you're purchasing the asset, this does not show the impact of the depreciation and deferred taxes on that asset. But I've had these slides up right now just to show the contrast between a divestiture, which we'll get to in a second. I first want to show how to do this acquisition in a model, in any standard model, and to illustrate that any well-built model with income statement, cash statement, balance sheet is designed to handle the purchase of a simple asset. So we talked about just a second ago in this Walmart model how to acquire. I had it open and then I had to restart it. We had suggested a $25 billion asset where we had to first raise $15 billion in debt and $10 billion in equity to fund the asset acquisition. So the first thing we said was, let's assume we're going to do it in 2017, far out. How do we, and what is the impact of raising $15 billion in debt? Well, we said, first you want to see what will change when raising debt. And what will change when raising debt is interest will go up. Of course, there's an impact to net income. That net income will impact the cash flow statement, net income. There is an impact to, we still have the equity raising here. There's an impact to the long-term debt. Let's assume that it's long-term debt. Long-term debt will go up, and that will impact our long-term debt balance. Balance sheet will go up. So but let me just, I've forgotten we had left with this equity raise case. I'm going to zero out the equity raise. I'm going to make this 0. Okay, so let's do it. So we can do this in the debt schedule where we're going to go in and we're going to raise long-term debt of, we said, $15 billion. And up goes our balance by $15 billion, of course. That balance increase should be reflected in our balance sheet. $15 billion, there it is. There's the jump. Cash should go up. There's the big $15 billion in cash going up. Jump. And our interest should increase. It does by $400 million. Notice our interest income, however, is also increasing because we have $15 billion in cash. That will be adjusted once we use that cash to buy the asset. So although we talked yesterday, there is an impact to interest income. That's only if you have all this cash and it's just sitting on the balance sheet, right? You're going to use that cash. We're going to spend it. Once we do the acquisition, that will kind of wash. Okay. Now we want to raise the equity. So what happens when we raise equity? When we raise equity, stock is going to increase by $10 billion. Cash will increase by another $10 billion. And we should see more shares. So in the cash flow statement, we can do this in the issuance of common stock. We'll put in 10 billion. And when you do that, we talked about that we hard code it there. Here's another 10 billion. It was 22, now it's 32. And the shareholders' equity now goes up. Sorry. From 4 to 14. Common stock. So we have stock, we have debt. And on the income statement, we have even more interest income. It went from 300 to 400. And we should have more shares. These are the number of shares that we raised, 135.5 million at $73 a share. We had already built our model to handle stock issuances. And we talked about the impact of that. It is dilutive. Raising equity is dilutive because of the new shares raised. Raising debt is dilutive because of the interest expense. Is buying the asset accretive or dilutive? Let's say it's non-revenue generating. It's just we're not going to increase revenue to that. We'll deal with that when we do the equity acquisition.
Dilutive.
Why?
Because if we're not getting any return from an operational P&L standpoint, then we're just going to have either fewer shares or increased interest payments.
And what else is the impact of that? There's another impact to buying this asset that would depreciation.
And then something about hard codes, because every question you've asked so far is having
hard codes. Yeah, and hard coded. Depreciation. Yeah. So think about that. When raising equity, the dilutive impact is the new shares raised, driven by the stock price. When raising debt, the impact is the interest expense, driven by the interest rate. When buying an asset, it's depreciation, right? Driven by the useful life and the value of the asset. So let's plug in modeling the asset. So I'm going to force it a little bit. Yes, it's probably better if we had reserved, I think Daniel mentioned this in the beginning, a line that says acquisition of asset. But then we'll have to wire it through. Let's just, for now, just to illustrate this so we can move on, I'm going to add on top of what's already planned. I assume this is operating. I'm going to add on to this $25 billion. So I'm just going to force it for now, even though I don't really recommend in the future. I recommend the hard code. To add a line that says purchase of asset, and then we have to wire it through. But just first, just to show you quickly the impact, I'm just going to add to this minus, because it's a negative, $25 billion. Although I never recommend hard coding in a formula, just to show you real quick, and then we'll do it right. 41. There's the additional 16 plus the 25. So what does that mean? What's happening? Well, the cash that we've raised should go back to the normal, whatever it was, 6 billion. So all that cash that we raised has been used. What else should we see to prove that this is working? PP&E should go up. Let's see. So our balance sheet, our cash should be back to how it was pretty much in the beginning. There's the 6 billion, 7 billion, I guess it was. PP&E should jump. There it is. PP&E's gone up by 25 billion. What else? And depreciation should jump. Yep. Significantly. There it is. 12 billion. So further diluting our EPS. I think it was like 6.2 or something. Big drop to EPS because of all those factors. But the real point is that the movements of a simple asset acquisition does not require any of this merger modeling that you read about and all this complex pro forma analysis. Not necessarily, right? It can be done in a standard model. The complex pro forma analysis is done when having to merge two major entities together. So what would happen to do it right? Let's say I hate hard coding in here. What would we have to do? Did I unadjust? I'm going to take this out. What would we have to do this right so that CapEx is separate from business acquisitions? I guess we can put it in business acquisitions, right? If we put it in business acquisitions, that would be minus 25 billion. Actually, I think that that's going to flow through, isn't it? As long as this links into CapEx, we're okay. I'd forgotten that line existed. That also works. That also does the same thing. Yeah, it also does the same thing. Business acquisition. All right. Could have just been simple and done that. Okay. So the difference here is in a merger model, as you know, and acquiring an entity, you have a lot more complexity. You have a business with accounts receivables and revenue and earnings. How do you acquire a business like that? And in that type of situation, there's full consolidation. So big difference. But it's still based on the same high-level theory. Price the asset, bring it in, raise debt or equity accordingly. So let's talk about, after the break, how to get into that. Let's talk about how asset acquisitions differ from divestitures. So a little bit of a different process. So in a simple divestiture, I'm talking simple like an asset divestiture, you have to be concerned about the value of the asset. So when acquiring the asset in its most basic form, usually you use the theory that the last price paid will be the new value. So you record the PP&E as per price paid. The concept of goodwill and the intangible pieces of that are reserved for more complex assets. When divesting an asset, you have to be concerned about the value because you are taking it off your balance sheet. You divest the asset. If the asset's on your balance sheet at 20 million and somebody pays you 25 million, you cannot remove 25 million from your balance sheet. You can only remove what the value was on your balance sheet. Yes?
Wouldn't it struggle to get a cost basis?
Okay, when you're making an adjustment for cost basis?
Well, figuring out how much the company actually needs to look at as its price to determine taxes.
Right. Okay, well, we'll get into all the taxes and the implications on that. Okay. Yeah, let's just talk about the core movements first. But there are major tax implications to either side. And the cost basis would impact the taxes and impact the deferred tax liability associated with that. So when divesting an asset, you are valuing it at the core book value of the asset less its accumulated depreciation, its net value. When I was just mentioning the example of somebody giving me 25 million for a 20 million asset, that difference in price paid versus net value becomes a gain or loss on sale. So we need to record the gain or loss on sale. And what's the impact on that? Well, that gain or loss on sale is impacted in the income statement, flows through cash flow and balance sheet, and I want to show you how. First, just going with this example. So in this example here, we had bought a $20,000 truck. We had raised $10,000 in debt to buy that truck. So sticking with that example, and that was very simple, so we did a more complicated one with Walmart, but let's say over time, that truck has depreciated. So let's say 7 years later, that truck's depreciated by $7,000, and the truck is now worth $13,000, $20,000 minus depreciation. You look at the net value. You want to sell it. It's worth $13,000 on our books. Somebody's offered us $15,000 for that. So we have a gain of $2,000. We have a gain on sale of $2,000. Okay.
Would that be like a line item that you put in for, let's say, other income?
Let's talk about how it goes. So this is kind of where how you, let's see if I can zoom in here. Yeah. So here is the income statement, cash flow statement, balance sheet. Before the sale, and what I want to do is I want to go over actually to the balance sheet first. Before the sale, what do we have? We had this truck. The net value of the truck is $13,000. We're going to say, let's say that the debt's been paid off. So really all we have is the value of the truck and equity of $13,000. $13,000 truck, $13,000 equity. And let's say after the sale, what happens is the truck is gone. We have $15,000 in cash, and our equity's gone up by $15,000. That's what we want to see after the sale, right? Somebody's given us $15,000, value of the truck goes away, equity goes up. How does this flow from the cash flow statement? How does shareholders' equity go up by $2,000? How does cash go up by $15,000? But the value of the truck only goes down by $13,000. Well, this is this is the way we typically record it. And for now, forget tax implications. We'll do on the board examples of tax implications. Before the sale, let's take an example of let's say the truck company has 100,000 in revenue, 90,000 in expenses, EBITDA is 10. It's got depreciation of 10, so actually the EBIT value is 0. What we do is we book, remember the value of the truck was 13, somebody gave us 15, there's a gain on sale of 2. That $2,000 gain on sale becomes a non-recurring event, $2,000. So we record that as a non-recurring event. That increases our net income by 2. So step 1, you have to record the gain or loss on sale as a non-recurring event in the income statement. This is step 1. That gain or loss impacts the cash flow. So let's look at the cash flow statement. The cash flow statement is cash flow before the sale, after the sale. Keep it simple. Cash flow net income 0. After the sale, it's 2. There are 2 things you need to do in the cash flow statement. One, naturally, you have to record as an investing activity, sale of truck. Sale of truck is the price received, $15,000. Price received for sale of truck. But you have a problem. If you've received $15,000 for sale of truck and your net income is higher by 2, then your total cash impact will be $17,000. But it's not $17,000. The total cash change is only $15,000. So you need to make an adjustment to adjust out that non-occurring item that you'd put in the income statement, the gain on sale. You remove it because it's non-operating in the operating activities, and you remove it so you're not double counting that gain with the cash received. So adjustment 1, you have to record the gain on sale in the income statement. Adjustment 2, in the cash from operations, you have to make an adjustment to remove that gain. Adjustment 3, you have to record the actual monies received from the sale on truck. This is how you get an increase in $2 million. This will go into our shareholders' equity. This will increase shareholders' equity by 2. And our cash will increase by $15 million. Now, what about the balance of the truck? The value of PP&E needs to be adjusted by only $13,000, the core value of the truck, not $15,000. So we need to adjust our PP&E by the $15,000 after the gain on sale, the sum of the 2. A lot of people get confused by that. Why is a gain or loss on sale going into my PP&E line? And this is exactly why. Because you're actually adjusting for the value of the sale that's been above and beyond the actual value of the asset. So it's the sum of the sale and the removal of the gain that flows into our PP&E. That's how you make that adjustment. Let's look at it on the board, and then we'll model it. So let's assume that we're going to do a sale of an asset in Walmart. How do we model that? So what I first want to do is undo the purchase. So what I'm going to do is let's go to the Walmart model. Let's undo the purchase. So I'm going to say I didn't purchase that asset. I didn't raise the equity. You guys okay? Just zeroing out K25, zeroing out K33, and then going to the debt schedule and zeroing out the $15 billion. And rather, I'm going to sell an asset. Let me just do one that's significant enough. What's the PP&E balance here? Okay, 140. Let's say we sell a $40 billion asset and we get $50 billion. Let's say we do that. So what should we see happen? We should see the PP&E go down by 40 billion. We should see cash go up by 50 billion after the tax on the gain.
How are we going to incorporate the tax? Oh, that's the income statement.
So yeah, so let's go to the income statement. I'm just going to you'd probably want to do an assumptions tab, but I'm just going to do here sale of asset just to save, okay? And I'm going to say asset value and I'm going to say price received, tax on gain. I think that's enough. And so let's say we said the asset value was 40, the price received was 50, and let's say tax on gain, I'm going to make it 40%, something a little bit more reasonable. I just want to format these a little bit. That's already formatted good. I just want to put a percentage in here. And just thinking ahead, I wonder if there's anything else that would make it easier. No, I think that's all we need. Okay. Can make a little box in there or whatever. So how do we model this in? First, as we drew on the board, we want to record as a non-recurring event gain on sale. We had this line other that I said I reserved for something later. This is what I reserved it for. So now we can use other for gain on asset sale. Okay. And what's the gain? And I guess what I should have done, let's see. I'll do it like this. I'm going to do it like this. Just so 2000, I'm going to do it like this. We're going to do the sale in 2017. Are these all hard-coded? Just so we can build the model so it's robust to handle a divestiture in any year. Okay, but I'm going to make it 0. Okay, so now we can, right, so now we can link it up. We can handle this in any projected year. But let's say we just really care about 2000. We're going to do a divestiture in 2017 for now. So the gain on asset sale is going to be the tax affected gain, right? So it's going to be equal to the price received minus the asset value times 1 minus tax rate. Right? After tax gain. Which is 0 here, but it's 6,000 here. Again, I want to make sure this is linking through, and it is. Okay. Any questions on that? Okay. Next, we want to reverse it. We want to reverse the grossed up value. So on the cash flow statement, first of all, our net income has gone up to 24. Our cash flow statement should reflect that. This is linking from, okay, sorry, 25 right before distributions, right? Because distributions are 25. Okay, now I want to add a line in the operating activities for adjustment gain on sale. And it's going to be 0 hard-coded. That didn't exist back then. Or I guess, you know what, I'm going to link it. I'm going to just link it every year. I could gross it up, or this is one. There's a couple ways to do it. I'm going to hard code it. And I'm just going to link this in from, where does it come from? Say again? Nope. Yeah, pre-tax. Calculate the gain. Okay. Pre-tax gain. It's the pre-tax gain. I may want to make sure my totals include all this stuff. Yep. Okay. Yep. So we're adjusting the pre-tax. We still pay the taxes on it. Okay. And then do I have a here? We can use this. Just well, let's just make it completely separate. Sale of asset, which is 0 historically. And for sale of asset, we link it in from the actual money received on the income statement. price received. I want to make sure that that adds in. Okay, it doesn't. So I want to make sure, quickly sure that my totals have been adjusted to add in that new line. Just want to always check for that. There's my money received. Right? And so, you guys got that? Yeah. On the balance sheet, I should see big pop in cash. There it is. PP&E, I want to just make sure this is linking in from those additional sales, right? In order to make this balance. I don't think this is going to balance. No. Because we need to do our final link. So based on what we did on the board, we added in the gain, made an adjustment for the pre-tax, put in the sale. I want to make sure that the gain and the sale go into our PP&E. So we want to add in minus the sale of the asset minus that gain adjustment. I'm just going to copy this to the left to make sure that it's included and incorporated so we can conceivably do this in every year, and it should balance. Now it balances. PP&E has gone down, and there's the divestiture. Any questions on that? Chapter 4. There's another problem, though, in your model. What's the other problem? Depreciation. It's a pain. There's really no easier when buying an asset because you're just upping capex and that flows all the way through. In a divestiture, it's a little bit more. We got $40 billion of core PP&E that's going away. And if you go to the depreciation schedule, there's really no straight formula for impacting this. It's a portion of this that we've sold, the core PP&E, assumed, which is a portion of this existing PP&E. So
how would you get rid of that asset if you're depreciating it? Would you say that since you're selling it that year, would you know how many years left?
No, you wouldn't. And this goes back to the same problem we have when projecting depreciation and you don't know enough about each individual asset. You need to actually know the gross value of the asset, the original price purchased, what the original depreciation amount was, to know how much is going to go. And you'll probably never really get into that. You have to make an assumption. And what I would do, we can just do it really quick, but it's not so systematic, is I'd add a row under existing PP&E. I'd call it sold asset, right? This is the way we did it at like Morgan Stanley. And we would you'd have to do, okay, well, and this is kind of ad hoc, we'd highlight it. So you go to the income statement and you'd go, all right, well, the value of the asset sold was 40 divided by 14 years. That's the amount that's gone. I'll make it negative. Okay. And that'll total, well, that's weird, that's formula. That'll total into this. Okay, that brings it down. Did that bring it down properly?
Are you supposed to do it for every year? Or just
Well, it was sold in that year, so you wouldn't do it before it was sold, right?
that was sold in 2017?
Yeah.
But if it was sold in 2016, you would do it in 16.
These 2 years, yeah. I'd have it here and here, bless you.
Would there be a situation where if you're selling an asset, you sell pieces of it? Let's see.
Yeah, you could. Yeah, it gets complicated. Sure. And you'd probably have an asset sale tab. What you would do is you'd have an asset sale tab, and you would create like a negative depreciation schedule have a total that would stagger, and then that would add it. So when you have depreciation on your income statement, you have depreciation plus the negative depreciation from the asset sold tab. There are more complex ways to break that out, but honestly, this is usually all I talk about in terms of depreciation because very rarely do you get involved in that in interviews and things like that. It's more on the acquisition side than the merger side. So I talk about it in the book. I don't even model it in the book, I don't think. It's important to know about it. You might get asked, how do you do it given the tax implications? But in terms of modeling it, and it's so ad hoc. So I'll stop at this for depreciation, but I can email it out. Do you have questions on depreciation? Whoa.
So you're not gonna put that line item in there, or?
The depreciation one?
Yeah.
I took it out. Hold on, let me save this. But that's how you would do it. I would do it a little bit more robust so you can copy it left. But I want to get to M&A. Okay. So how do we get there? Well, we just did that. Getting back to acquisitions, we talked about acquisitions of assets, and we talked about how that compares to an acquisition of equity. There's a difference. There's a significant difference. When you're acquiring something that's operating and that has revenue and cost tied to that revenue and a balance sheet and working capital and shareholders, you need to think about acquisitions in a little bit more complex level. How do you think about that? Well, you need to think about actually integrating all that companies or entities or targets financials into the acquirer. And so actually, despite that, when acquiring an entity that has all these moving parts, you can think about an acquisition of an entity like that as an acquisition of assets or as an acquisition of equity. So it's very important to make that distinction. So what do I mean? Well, let's look at a power company, Con Edison. I guess I don't know if you guys have to deal with Con Edison, but they own a portfolio of assets. And actually a larger, maybe more national power company would own a bunch of different assets that operate at different times, and they'll buy assets and sell assets and hedge them, have some assets in Florida where it's warm all the time and assets where it's cold, and would hedge them like a portfolio, right? Like a whole portfolio of assets. If a power company would buy another power company, they're really just concerned about the assets. They're not concerned about the people or the liabilities or any financings. So a lot of times when a power company, this is just an example, would want to buy another power company, they're only concerned about the assets. They're concerned about picking off select assets. They want to acquire the business as an acquisition of assets. And very much the case that it could look like what we did on the board, where they have an appraiser, they value all of these assets, here's the value of the assets, we're going to pay for just those assets, you leave the shell company. A lot of times that's attractive to buyers. And you would raise the equity, the amount of equity raised, you'd raise the debt, the amount of debt raised, and raise the PP&E accordingly, and then the revenue adjusted. Now, if you think about a business like a consulting business, let's say, where the core fixed assets is not really what you'd want. You'd want the relationship with the clients, the customers. You would need to acquire the whole business. You would need to absorb the working capital and the liabilities. Then that gets more complicated, right? Then you need to absorb every single line item. And how do you do that? You had a question.
So I guess utilities companies is one industry. I guess financial institution groups are another one, with banks and stuff that you would only acquire.
Depends on the services they provide.
Okay. So what are some other industries that would only specify, like specifically want to target?
Real estate, maybe. Although each hotel operates,
Oil and gas too.
Some types of oil and gas. Yeah, that's right.
Pretty much all the project.
And that was a crude example because there's some branding elements to some energy businesses maybe that you might want. But yeah, like a pipeline, maybe. Yeah, just examples. And so the reason why I'm saying that is there's often this fight that a buyer would often just want to acquire the business and treat it as an acquisition of assets when the seller wants to get rid of everything, right? Why does he want to get stuck with a shell company and all these liabilities? Whereas a buyer, why do I want to get stuck with liabilities that aren't directly associated with the assets? So there's this back and forth. So it's important to understand that there are three ways to treat an acquisition. There's an acquisition of assets, there's an acquisition of equity, and then there's a hybrid. It's important to understand the hybrid. There is a huge benefit to an acquirer acquiring a purchaser acquiring a business and treating it as an acquisition of assets. And the benefit is getting to step up the value of the assets to book value. Now let's flesh in on that a little bit. I told you before, in a simple asset acquisition, when you're buying the asset, usually the price paid sets the new value of the asset. PP&E goes up with the new price paid. There's a big benefit to that. As opposed to in an acquisition of equity, that equity has a core value, the book value, the shareholder's equity. Whatever price you've paid above and beyond that gets tied up in goodwill and intangible assets, and you account for that differently. That's less preferable. Why would you think that's less preferable? Why is it more preferable to get to step up the assets? Tax benefits of depreciation. So a buyer would usually favor an acquisition of assets, number one, because you're not stuck with all these liabilities that might not be directly associated with those assets. And number two, because generally you can step up those assets to the PP&E and get full depreciation. Whereas if you acquire the business and acquire the whole entity, the whole shell company, then you're dealing with acquiring all the liabilities, even things like pensions and deferred taxes and things that you might not care about. And you don't get that step up. There are exceptions to the rule, but that's generally. So the third method is called a 338H10 election. You got to memorize it. It'll be on the M&A test or the LBO test. It's the best of both worlds, where the buyer can treat the acquisition as an acquisition of assets. At the same time, the seller can treat it as a sale of equity. Well, how does it work? Well, actually what's happening is you're selling the whole business, you're acquiring the whole business, but you get the benefit of stepping up that difference between price paid and book value, not as goodwill, but you're stepping it all up to PP&E. That's actually what you're doing. You're acquiring the whole business, makes the seller happy, but instead of having this goodwill gap, because we'll talk about goodwill, but goodwill you cannot amortize anymore, right? And if you file a 338H election, that difference, you can get the tax benefits of depreciating and amortizing. That's basically what it is.
So that's basically why we wanted the assets now.
Yeah, before goodwill you could amortize, before 2001. Yeah. Now they've changed that rule.
So the way, I don't know, maybe this may be a way maybe some companies could acquire some companies that had assets and make it look like they're worth more, get more tax benefits.
Yes, that was a problem that was happening. Yeah, that was a problem that was happening pre-2001, pre that rule, the FAS 142 rule. And so the rules change on who can file for it. You have to file for it. The government has to approve it. Who can file for it? But typically, you won't need to know this much, but acquisitions of S corporations, small corporations, not C corporations, and so if you're acquiring subsidiaries of larger corporations can file for this, but you can't do a full-out merger of a public company or actually a public company and expect to get this done. This is a U.S. rule, yes. In IFRS, you can amortize goodwill over 15 years. We'll get to a table in the M&A, IFRS versus GAAP, because it's important for a lot of you guys I know what the differences are. And in all honesty, this is GAAP. For tax purposes, you can't amortize goodwill anyway. So a lot of times, it doesn't matter. For like LBO, sometimes private company, it doesn't matter. Because for tax purposes, you can always amortize goodwill. This is just GAAP. So important to know, if anything, to look smart. If people say there are three ways to acquire a business, there are three methods: acquisition of assets, acquisition of equity, 338H10 election. That's why it's on the test. It's an important question. So we'll talk about that. No matter how you do it, whether it's an acquisition of equity or a 338H10 election, the core fundamental process is the same in terms of rolling up and adding every single line item from the target to the acquirer. That's the way it's done. And tomorrow we'll talk about how it's done. Okay, so tomorrow we'll talk about the process, the accretion dilution process, how to merge two companies together. I want to give you the high-level perspective so you can talk about it in an interview, do some paper examples. We'll start going in, if we have time tomorrow, but probably Monday, into the mini merger model. Good lessons in there. We'll do it of the tech companies. And then we'll roll into the full scale analysis next week.